market is selling off today because really you got stagflation, stagnating economy with higher than expected inflation. What's interesting though is bond yields are actually coming down today by quite a bit and stocks are falling. That's not the stagflationary response that you would expect. In fact, today Wall Street's a little bit more concerned about the possible recession. We'll talk about that later on throughout this video, and unfortunately, it looks like equities could be set to move lower. There's not a lot of fear out there. The VIX has reset, RSIs have come back down. We have our big catalyst coming next week, April 2nd, and Goldman Sachs even suggests we're set up for a negative surprise there because Trump has signaled this flexibility in which we may not see initially, okay? We'll get into the more nitty-gritty details of all of this, but first, Tom Lee actually thinks next week's catalyst on Wednesday, April 2nd, Reciprocal Tariff Day, or Liberation Day for America, could be a V-shaped recovery for stocks, something aggressive to the upside. Take a listen to this.
It's sliding in the final hour of today. BlackRock's Rick Reeder saying last hour that the animal spirits that helped drive the market higher at the end of 2024 are part of what's hurting stocks now. Take a listen.
We came into the beginning of this year. It was all about animal spirits, and it seems like it's moved to animals in hibernation from animal spirits, and that can translate into a bit slower growth for a couple of quarters.
So that was interesting to me, Tom Lee, as I bring you into this conversation, the head of research at Fundstrat and a CNBC contributor, because he's talking about animals in hibernation, not animals dying. It goes back to this idea of uncertainty around things like trade and tariff policy and the fact that as of right now, in the midst of that uncertainty, perhaps companies are sitting on their hands before they start to make any kind of future investments. So if that's the situation, how much does getting some sort of certainty now frame the investment thesis for how you position yourself moving forward?
I think that's exactly what's happening now, Morgan. First, in 2018, which Michael was talking about, the spike in the VIX or the collapse in investor sentiment or consumer confidence, that all happened around February 2018. So really that coincided with that first low that was made in 2018, and the market began to stage its recovery. I don't blame any business or investor for saying, look, there's so much uncertainty, I can't make a decision. I think that's why Rick Reeder's talking about animals in hibernation. But as we start to think about the second half of this year, first of all, we've already had the collapse in sentiment. We've seen $850 billion of cash raised over the past year on money market balances. And then in the second half, we're looking for possibly tax reform, which really propelled stocks in 2017. So I think that the odds of a V-shaped recovery in stocks that come after April 2 is just extremely high because we've already sequenced a lot of the panic that people saw in 2018. I think it's already taken place.
So what would you be buying right now?
Well, to us, I think Exhibit A for a V-shaped recovery is going to be Tesla because it's really been one of the most controversial stocks, and it's been caught in that sort of political maelstrom of Doge and Elon Musk's involvement in the White House. And I think it's already recovered more than 15%. But I think if Tesla is leading us into this bounce, that's a bull case for Mag 7 to be the group to own in the next few months.
So you like Mag 7, even though we've been talking about things like cash burn at Microsoft and all of the CapEx investments and worries about a bubble in AI spending?
Yeah, I mean, in some ways, it's been a self-amplifying downturn, right? Because we've been worried about AI as a bubble and the CoreWeave IPO at a time when we have tariff uncertainty. So I could see it as a very convenient reason why investors have actually avoided Mag 7, and it's been the group that kind of really led the downturn. But it is a cyclical trade too, because I think once investor confidence returns and they're going to start to buy stocks, the Mag 7 are not only the best companies, but they're the most liquid and they've really derated. On top of that, I think, financials and industrials look attractive as well.
What do you think it takes to see that reversal in sentiment. And we talk so much about when sentiment gets negative enough, it becomes a contrarian buy signal. So if we're there now, then what are going to be the catalysts to start to shift that confidence again?
Well, I think the focus right now is on April 2. So I think the market has a lot of myopia around getting tariffs and tariff clarity. But we know that tariffs are just one part of the administration's goal. You know, there is reducing regulatory cost, and then there is extending tax cuts. I think as investors start to think about that for the rest of the year, that gets them quite excited. And of course, I think we have a lot of what I would call spooled energy. You know, investors can't stay this bearish. The VIX can't stay this anxious. There is a lot of firepower and dry powder on the sidelines, and I think businesses can't stay cautious forever. I mean, once they know the ground rules, I think they're going to actually start making decisions.
Okay, with that said, let's get into the important stuff. The data today, what changed and why markets are selling off. So let me just start on the trading economics calendar here, okay? And I should mention again, Lulu tends to cater to higher income consumers. They said things are slowing down. That stock is down a lot today. Okay, it has been doing well recently. The thought process is higher income consumers have been doing better. They may continue to spend, but that throws a little bit of uncertainty on that. And just so you guys are aware, 50% of all dollars spent in the economy come from the top 10% of income earners. The reason I'm a little bit more nervous this time around for the economy is those top 10% of income earners tend to be business owners. They tend to be more business owners, right? That's just the bottom line, right? And with tariffs and with a lack of investing going on right now and this uncertainty, that could hit that side of spending. Lower middle income consumers have already been in a bad place for a long time. Now, if the higher income consumers start to fall out, stocks, also the negative wealth effect, stocks falling, uncertainty, these red weeks also do not really help people's confidence when they are looking to spend. Okay, mix all of that together with Doge and uncertainties about government contracts and more additional layoffs from the government sector. You can make a logical case that this is kind of a shock to the economy. Could it be recessionary? It very well could be. Will we go into a recession? We don't know. Now, what's actually fascinating today is when you look at the data, it's very stagflationary. Like stagflationary almost to like a T. Like if you wanted stagflation for whatever your investing, thesis is, you got that today. What's fascinating though, during a stagflationary environment, stagnating growth and high inflation, that should really do one thing. Stocks should fall and bond yields should rise, right? Because the Fed's not really able to accommodate markets because of high inflation. Then you have stagnating growth, so stocks get hit from the growth side. What's fascinating today is TLT is actually up 1.3%. So people are actually buying bonds today. So even though the data was stagflationary, the markets are taking this as more of that growth scare than actual stagflation. Take a look at this. Core PCE month over month came in at 0.4%. The expectation was 0.3%, with some forecasts as low as 0.2%. So another hot reading there for PCE month over month. Personal income month over month was revised down from last month's number of 0.9% down to 0.7%, fine. But this month's number came in at 0.8%, double the forecast of 0.4%. That's not exactly great for the inflation outlook. Personal spending was revised lower from last month, from negative 0.2% down to negative 0.3%. The expectation for today's data was positive 0.5%. You came in at 0.4%. So last month revised lower, this month came in weaker than expected. Like a double whammy there. Not great at all, okay? And then you have your Michigan Consumer Sentiment Survey. Final numbers for March. The headline came in at 57.0. The previous estimate was 64.7. So you came down a lot there. 5-year inflation expectations hit a new 32-year high. Yeah, 32-year high today. coming in at 4.1% versus the estimate of 3.9%. Yeah, that's about as stagflationary as you could possibly get looking at this data. Consumer expectations came in at 52.6 versus last month at 64.0 and estimates of 54.2. So worse than expected. Current conditions came in at 63.8 versus last month at 65.7 and expectations of 63.5. So that actually came in a little bit better than expected, but not enough to kind of move the needle here. And 1 year inflation expectations came in at 5%. Last month they were at 4.3%, and the estimate was 4.9%. So weaker economic activity, weaker personal spending, higher PCE, higher inflation expectations, weaker expectations for the future growth in the economy, and basically in line current conditions. That is about as stagflationary as you could possibly get. Again, but with bond yields falling today, it makes you wonder what's going on, because that's not a stagflationary trade. A stagflationary trade is really what we've seen over the past 2 days, where stocks have been selling off and bonds have been selling off, aka yields moving higher. So something is changing a little bit today. People are getting more nervous about the economy. Now, if we look at what markets are pricing for Fed policy for May 7th, yesterday there was a 9.2% chance of a rate cut on May 7th. Today it's 10.9%. So there's definitely not a whole lot of growth fears still even out there, which again, kind of alarming, whichever way you want to take this. If the economy does weaken further from here, it's not really priced in, at least to the odds of the Fed cutting rates. Normally, growth expectations kind of tie into rate cuts. If we expect weaker growth, we're going to get rate cuts faster. You're not really at that point. We are expecting the first cut, again, coming June 18th, 67.1% chance of that. Yesterday, it was only sitting at 59.8%. So those odds are moving up quite a bit. The odds of 2 cuts by June 18th moved up as well from 5.7% to 7.8%. But the previous week probability was 10%. So even though markets are selling off, it seems like a bit of a growth scare out there. It's not nearly as bad as it could be, right? You were more fearful about growth a week ago from the perspective of what the markets are pricing in for Fed cuts. So that doesn't exactly give me confidence that markets are at a place to stage a recovery. Now, also, as Goldman Sachs has recently suggested, you may be due for kind of a upset, like a surprise, a negative shock, a negative surprise coming April 2nd because of what Trump has said recently about being flexible and tariffs are not, quote, as reciprocal as they are just, going to go on countries. Because if it was reciprocal, Trump says it'd be a disaster for these countries. Yeah. Obviously, that's true, but it sounded like Trump was going to be lenient, and on April 2nd, it may not be as lenient as people think. That's the note that came out from Goldman Sachs yesterday that also did, help to hurt markets in the last couple of days. Now, that is going to be next Wednesday we get reciprocal tariffs. So between now and then, if we sell off a lot, maybe you price that in. I don't think at this point you're pricing in a super bad, maybe stagflationary environment from tariffs. So again, that gives me a little bit of pause to say maybe we could fall further from here. If we do take a look at the CNN Fear and Greed Index, you're sitting at 23 today. Yesterday, you were at 27. All categories are in extreme fear. Besides market volatility, that is neutral, and junk bond demand is also neutral. Again, that's one of those things that doesn't make me super confident because, the VIX is now only at 20.60 and you're almost at a new low again. So we were recently at 27 on the VIX and you didn't really get that big fear spike. It kind of just crept higher. Well, now we're barely moving higher and markets are falling. So you're not even close to really that capitulation, if you will, that normally marks the end of correction. So from my perspective, I'm not really seeing a lot of signs that the correction that we are in is is imminently coming to an end. I guess that could depend on April 2nd and what plays out there. Now, the AI investor sentiment survey that we got out today also suggests that people are getting a little bit more bullish out there. Bullish investors jumped from last week at 21.6% up to 27.4%. Neutral investors stayed roughly the same, going up 1 point to 20.4%, and bearish investors fell about 6% down to 52.2%. So still, you're above 50% on the bear side. People are still overall pretty bearish, almost twice as bearish as they are bullish, but it's starting to come down a little bit, which again, maybe opens the door for a little bit more downside. It's kind of like 2022. Where you like stop and go. Next thing you know, you were in a bear market, right? You had these falls, these rallies, fall, rally, fall, rally, fall, rally, fall, and next thing you know, you're down 27% after a couple series of that. I don't know if that's starting now, but it does kind of feel like that. Obviously, it depends what happens with the economy, what happens with inflation, and whether or not we do go into a recession. You can see the percent of stocks trading above their 50-day moving average today coming in at 27.17%, down about 4.1% today, so moving towards the lower end range, but still elevated from where it was at some of the lows we had recently at 21% or so. And here's something that I do not agree with. Nikola's founder, Trevor Milton, receives a full pardon from President Trump. Nikola founder Trevor Milton announced via Instagram that President Trump issued him a full and unconditional pardon. Milton faced charges of securities fraud. That's exactly what it was. I mean, I'm not like the president. I don't know the inside scoop of that. But if you just, roll a semi down the road and down a hill and take investors' money and raise capital as if you have a product when you don't have anything in that semi truck, like nothing is propelling it. I think that is securities fraud. Now, should you go to prison for that? I don't know. Should you have to give back all that money? And should you personally not have benefited from that? Yes. Maybe prison's a little extreme, but you definitely shouldn't benefit financially the way that he did from a scam like he pulled. So I don't know. I just thought that was a shocking headline. I mean, honestly, if you're going to pardon Trevor Milton, you might as well pardon Sam Bankman. Like they're kind of in the same category, just instead of they're really in the same category. It was crypto versus stocks, like the same exact thing to a certain extent. UBS Global Wealth Management cut their S&P 500 2025 year-end index target to 6,400 from 6,600. Again, I still think that's pretty optimistic, even though you've seen more firms start to cut targets. I think you could be due for a lot more of these cuts coming here in the relative near-term future. Fed Daily says today that 2 rate cuts is still a reasonable projection for 2025. Fed Daily says the policy is in a good place and they have to be patient to ensure inflation comes down. He says we need to wait and see posture on monetary policy, give industries time to adjust to tariffs. They also say that growth and labor markets remain solid. Again, I don't really think Wall Street is responding to these regional Fed presidents. I think they're only responding to Powell at this point. Like these comments just don't move the needle anymore. And Fed Daily says, I'm hearing cautious optimism from businesses. Mexico's President Sheinbaum says USMCA helps North America compete against China. So seems like she could be trying to throw a wedge between Mexico and distance them from China to try to help lessen maybe some of those reciprocal tariffs coming next week. Mexico's President Sheinbaum also says that Ford, Stellantis, and GM are affected by tariffs. We can see that based on how those stocks performed yesterday. It was brutal. Donald Trump says he spoke with Canada's Prime Minister Carney. He concludes by saying they had an extremely productive call with the Canadian Prime Minister and schedules future talks after the election. Trump says that him and Canada's Prime Minister agree on many things and will be meeting immediately. And what are the odds of a US recession in 2025? According to Kalshi, the betting website or platform, it stands at about a 40% chance as of now. Larry Summers is at a 50%, JP Morgan at 40%, CNBC Fed Survey at 36%, Moody Analytics at 35%, PIMCO at 35%, and Goldman Sachs at 20%. So that's kind of roughly in line with some of the targets or some of the projections you see on betting markets today, which is pretty interesting. So let me know what you guys think about all of this down below in the comment section. I'm kind of neutrally bearish here, I would say. I think there's more downside risk, but it's really hard to say. Does it happen soon? Are we imminently going into a recession, or is it going to take a fair bit of time that maybe we may not be expecting? Who knows? Now, a new Atlanta Fed GDP Now update is out today, coming in at negative 2.8% GDP. There is a new alternative model forecast that they are using right now, which adjusts for imports and exports of gold. And excluding that, you're down 0.5% in Q1 GDP. So you can't really make the argument that gold is this weird anomaly pushing down Q1 GDP. Like, you're almost out of Q1 now, and you're negative 0.5%. Now, there's going to be more data to come. Things will get finalized here, but it is very possible that you're going to have a negative Q1 for GDP. I don't know if Q2 is going to be much better, and I don't know what's going to happen with the labor market in that regard. If the tariff trade war uncertainty comes to an end relatively soon, then maybe that lessens some of the recession risk, or maybe the damage is already done. Again, as Jerome Powell cited on the podium many times, there's a lot of uncertainty with this. We just don't know. In this kind of environment, I think you want to stay invested in markets, but you want to reduce exposure in companies that may not survive a recession, companies that could be vulnerable to going to zero during a recession, companies that need to raise capital over the next 2 years, maybe longer than that, are extra vulnerable. Right? Companies that are not at least free cash flow positive are extra vulnerable. Some of those companies you might want to be a little bit more choosy with. And I think having cash ready in this environment is the best way to operate. If things get worse, your $100 today or $1,000 today could 10x if you're investing at the bottom of a crash or recession, right? So I think the cost of capital right now, what your dollar is actually worth, is growing as markets fall. And I think it has the potential to grow a lot more if markets do fall more. And I'm still remaining steadfast with, at 500 on the SPY, which I think we could probably get to. In all reality, that takes you back to April of 2024. Like, that wasn't that long ago. If you get to 500 on the SPY, which is right around your 500-day moving average, the risk reward seems at parity to me. At 500 on the SPY, I think you have roughly 20% additional downside potential. Okay, not base case, but downside potential. That would put you down to about 400 on the SPY, and you have roughly similar upside potential of about 20%, which would put you back up to about 600 on the SPY. I like deploying more capital in markets, even buying the SPY, just S&P headline index, if you fall back to about that 500 level on the SPY. That would be a pullback of about 18%. Don't know if we're going to get there, but I think you should be prepared for that. You should be prepared for markets to V-shape recovery, as Tom Lee also said. That's why you want to have exposure, but you want to have cash. You don't want to be in margin here. Okay, so it's really a balancing game because we just don't know what's going to happen next. I mean, the last thing you want right now is margin too. Like, if you got to take some losses to get out of margin, I think that makes sense in this environment, even as markets are down 8.5% or so from all-time highs, because again, you have potential like 30% downside from here, 35% downside from here. Your upside potential is like 10%. Oh well, if you miss a little bit of upside here. That's kind of the way that I'm looking at things. So let me know what you guys think. Let me know your thoughts down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.